In the world of banking, three names tower above the rest: JP Morgan Chase, Bank of America, and Citibank. Together, they move trillions of dollars, hold the savings of hundreds of millions of people, and sit at the heart of the global financial system. But what makes them fascinating isn't their size. It's the way each of them tells a completely different story about money. JP Morgan Chase is Wall Street's fortress, built on centuries of deal making, financial engineering, and a reputation for being too strong to fail. Bank of America is the people's bank, born in San Francisco with a radical idea of serving immigrants and small businesses, and later transforming into America's largest consumer bank. And then there is Citibank, the globetrotter. From New York to New Delhi, Citi has built its brand and international reach, becoming the go-to bank for travelers, corporates, and governments alike. These banks have been able to survive difficult times like depressions and the 2008 financial meltdown as well. Yet today, they face a new battlefield, which is digital disruption, fintech challenges, and a world where trust in banks is constantly tested. So the real question is, in this race of history, scale, and strategy, which of these giants is best prepared for the future? So Chapter 1 will focus on the tale of the three banks, their origins. The roots of these three financial giants stretch back more than a century, and each carries a distinct origin story that shaped its DNA. Now, JP Morgan Chase traces its lineage to the legendary financier JP Morgan, who helped fund America's Industrial Revolution in the late 19th and early 20th century. The bank we know today is the product of countless mergers. Chemical Bank, Chase Manhattan, Bank One, all eventually consolidated under the JP Morgan Chase umbrella. Its foundation has always been the strength and stability, and even now, it is often described as having a fortress balance sheet. From the days of rescuing the US Treasury during the Panic of 1907 to leading the modern day Wall Street, JP Morgan has positioned itself as the ultimate symbol of American financial power. Bank of America was born on the opposite coast with a very different mission. In 1904, an Italian immigrant named Amadeo Giannani opened the Bank of Italy in San Francisco, determined to serve working-class families, immigrants, and small businesses, often ignored by elite banks. His radical vision of banking for the common person led to rapid expansion. After surviving the 1906 San Francisco earthquake, his bank rebuilt stronger and eventually rebranded as Bank of America. By the mid-20th century, it was pioneering in credit cards, branch banking, and becoming a consumer finance powerhouse. Citibank, on the other hand, started as the Citibank of New York in 1812. From early on, it sets its sights on being more than just a domestic player. By mid-20th century, Citi became the most international of US banks, building a network across Latin America, Asia, and Europe. It was the bank of choice for multinational governments and travelers, a global reach that none of its US peers could ever match. So while JP Morgan stood for Wall Street muscle, Bank of America for Main Street accessibility, and Citi for global reach. These identities still shape the way they operate today. Chapter 2: The Rise and the Crisis. From much of the 20th century, these banks expanded aggressively, but it was the early 2000s and 2008 global financial crisis that truly defined their modern identities. JP Morgan Chase entered the crisis from a position of relative strength. Guided by CEO Jamie Dimon, the bank had taken fewer risks in subprime mortgages compared to its rivals. When the storm hit, JP Morgan was in such strong shape that regulators asked it to absorb two falling giants, Bear Stearns and the Washington Mutual. These acquisitions expanded its reach but also cemented its reputation as America's most resilient bank. Unlike others, JP Morgan came out of 2008 not weaker but stronger. On the other side, Bank of America faced a far bumpier ride. In 2008, it made the bold move of acquiring Merrill Lynch, one of the Wall Street's premier investment banks. Just as markets were imploding, on paper, this gave BOFA instant dominance in wealth management and investment banking. In practice, it also inherited massive losses and years of lawsuits tied to bad mortgage securities. The deal nearly broke the bank, and only after a long decade of restructuring and paying tens of billions in settlements did BOFA stabilize. Still, the Merrill deal transformed it into a true universal bank with a presence in everything from checking accounts to global trading floors. Citibank, however, was the one that came closest to collapse. Citi had piled heavily into the risky mortgage-backed securities, and when the bubble burst, losses mounted quickly. By late 2008, it needed one of the largest government bailouts in US history, about $45 billion in tough funds plus hundreds of billions in guarantee on toxic assets. Citi survived, but at a huge cost, and it was forced to slim down, sell businesses, and rethink its global sprawl. The crisis was a turning point. Now, JP Morgan emerged as the model of strength, Bank of America as the survivor who reinvented itself, and Citi as the fallen giant forced to retreat. Now, these scars and lessons still shape how each operates today. Chapter 3, the numbers, performance over the years. When we compare Bank of America, Citibank and JP Morgan today, and the sheer scale of their operations is staggering. Yet their numbers tell very different stories about size, profitability, and market positioning. JP Morgan Chase is the undisputed heavyweight. With assets of roughly $4 trillion, it is the largest bank in the United States and one of the largest in the world. In 2023, it generated close to $160 billion in revenue and nearly $50 billion in net income. Its return on equity consistently leads the industry, often exceeding 15%, which signals both efficiency and profitability. Under Jamie Dimon, it has become the gold standard for banking performance. Bank of America is not far behind. With assets of around $3.2 trillion, it is the second largest US bank. Its 2023 revenue stood at roughly $100 billion, with net income near $27 billion. What sets Bank of America apart is its massive retail presence. It serves over 68 million consumers and small businesses clients and operates thousands of branches across the country. Its strength lies in scale on Main Street, particularly in checking accounts, mortgages, and credit cards. Citibank, or Citigroup, as the parent company is known, has assets of around $2.4 trillion, making it the third largest among the rivals. It brought in roughly $78 billion in revenue in 2023, with net income closer to $15 billion. Citi's standout feature is its international footprint. It operates in nearly 160 countries, far more than JP Morgan or Bank of America. That reach makes it a leader in global transaction services for corporations, governments, but it also comes with higher risk in volatile markets. In terms of stock market performance, JP Morgan has rewarded investors the most. Over the past decade, its stock price has grown by more than 150%, significantly outpacing Bank of America and Citi. Bank of America has recovered strongly from the 2008 crash, with its stock rising nearly 120% in the same period. Citi, however, has lagged, still trading well below its pre-2008 highs and delivering more modest returns. These figures underline the hierarchy. JP Morgan dominates on profits and efficiency, Bank of America thrives on consumer scale, and Citi remains the global connector but with a less consistent record. Now the next chapter, which is the present, where they stand today. In today's banking landscape, these three institutions remain the pillars of global finance, but each occupies a very different space. JP Morgan Chase stands at the top of the hierarchy. Under Jamie Dimon's leadership, it has become the benchmark for stability and performance. The bank dominates both investment banking and consumer banking, with leadership in trading, asset management, and credit cards. Its digital banking app is one of the most widely used in the US, and it is consistently rated highly for customer satisfaction. More importantly, JP Morgan generates record profits year after year, which gives it the financial muscle to invest in emerging technologies like artificial intelligence and blockchain at scale that the rivals just cannot match. Bank of America is the closest challenger. It has built the reputation as the ultimate consumer bank in America. Like how I stated the numbers earlier, which is 68 million clients, one of the largest branch and ATM networks, Bank of America is deeply embedded in everyday financial life. It has also been at the forefront of digital transformation, with its AI assistant Erica serving over 35 million users and handling hundreds of millions of client interactions. This focus on consumer experience has allowed Bank of America to steadily grow profits, though not at the same pace as JP Morgan. Now, Citibank has taken a different path altogether. After struggling in the aftermath of the financial crisis, Citi has spent the last decade restructuring, and it has exited consumer banking in more than a dozen countries, choosing to focus on wealth management and institutional clients. Today, Citi's strongest division is its treasury and trade solutions arm, which handles global payments and cash management for multinational corporations. While less visible to the average consumer in the US, Citi still holds an unmatched global presence that makes it indispensable for international businesses and governments. Together, these banks define three different identities in the present. JP Morgan is the Wall Street leader, Bank of America is the Main Street's largest partner, and Citi is the international bridge connecting capital across continents. The future, challenges and opportunities. The future of banking will not be defined by branches or balance sheets alone. It will be shaped by technology, consumer behavior, entirely new systems of finance emerging outside traditional banking. Among the biggest of these is decentralized finance, or DeFi, which uses blockchain to let people borrow, lend, and transact without intermediaries. For the first time, large banks face the possibility that their role as middlemen could be challenged by code. Now, JP Morgan is taking this challenge head on. It has already built its own blockchain platform, Onyx, to streamline payments and settlements. The bank has run pilot projects with tokenized deposits and even explored issuing digital bonds on blockchain networks. Jamie Dimon is critical of cryptocurrencies, but he recognizes the value of blockchain in making finance faster and cheaper. This dual stance, skepticism of speculation but embrace of technology, shows how JP Morgan is preparing for a hybrid world where the DeFi models may emerge with traditional banking. The Bank of America is more cautious but still engaged. It has invested in digital infrastructure, filed patents around blockchain, and closely monitors developments in digital assets. Its focus on ensuring that if mainstream adoption of DeFi tools accelerates, Bank of America can integrate them into its consumer-facing platforms. Given its size and retail banking, it cannot risk falling behind if the consumers start demanding blockchain-enabled products alongside mortgages and checking accounts. Citibank may stand to gain the most if it adapts effectively. With its international footprint, Citi could see blockchain to simplify cross-border payments, trade finance, and treasury services for governments and corporations. It has already explored the tokenization of deposits and settlement systems in pilot programs. For a bank that thrives on global connectivity, DeFi-inspired innovations could reduce cost and increase speed in areas where traditional systems are slow and expensive. The rise of DeFi is not an immediate existent threat, but it is a long-term shift that these banks cannot ignore. The ones that successfully integrate blockchain, tokenization, and digital assets into their core operations will remain relevant. The ones that dismiss it risk being outpaced by nimble fintechs and decentralized networks. So that's it, guys. This was a deep analysis of how three of the biggest banks of the US and in the world are paving their paths. So tell us in the comments, what do you think about the next steps that these banks should be taking into the digital world? And subscribe for more such content only on Appreciate.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.